I don't want to fight no more. Only wanna get
Good afternoon, everyone. Welcome to the Cove. Thank you so much for showing up in this downpour. We'll probably have people coming in gradually, so I just wanted to tell you a little bit about the SBDC at UCI Applied Innovation. This is our second year starting here, and we have a number of extremely qualified consultants, one of whom is giving our Pitch Prep 101 presentation today. We are funded partially by and mostly by the SBA, the Small Business Administration, and their mission is to help businesses start, grow, and succeed. They also can help you finance a business with SBA loans, and there's a lot of great information on the SBA at sba.gov. The SBDC stands for Small Business Development Center. If you're not familiar with them, we're a resource for ventures from idea to exit. We provide one-to-one consulting, which is very personalized, relationship-based. We help businesses start, develop, and grow. And we help you get investor ready, so we help with funding readiness. We specialize in high-tech, high-growth, scalable businesses in the life science and technology sectors. And we, being based here at UCI Applied Innovation, have a lot of resources for small businesses to take advantage of in addition to our consulting. We do all of this at no cost, so the price is right. We have, as I said, a very strong group of consultants, and our metrics last year definitely showed that. They helped clients achieve $51 million in economic impact, capital infusions, so equity and loans. We counseled over 200 clients. We helped our clients create over 200 jobs, and that amounted to 1,600 hours of consulting. So you can see that for $0 on your part, we generate a lot of economic impact per hour. Our services and expertise, we do general business consulting, funding and pitch prep, term sheet, we can help with term sheets, equity and debt funding, SBIR, STTR. You need assistance with deciding if that's right for you. We have those resources available. We help with technology commercialization, sales and marketing strategy, and as your business grows, we can help you with boards of directors. And when you're starting out, advisory board assistance. We can also eventually help with hiring and staffing issues as well. We're located right here off the beach, and you can come see us anytime by appointment. If you want to reach out to me via email or take a look at our website, we have information about our upcoming events over on the table, as well as our services and cards for both Bill and myself and other consultants. We're proud to be sponsored today by Greater Irvine Chamber and Troutman Sanders. And Troutman Sanders has a special program called Ignite for small business. You want to take a look at their table over at the entryway there. They have some materials for you. If you have any questions about anything, please come up to myself or any of the other consultants at the end of the program. A slight change to our program today. We originally had Don Castle presenting. He is a victim of the flu. And so Bill has gallantly stepped in to cover both the do's and the don'ts today. I wanted to introduce Bill. I have his long resume here.
There it is, my
there
10
it
seconds
is.
of fame.
There it is.
Love it.
Bill Waldo. Bill Waldo is a senior consultant at the SBDC and has been with the SBDC for 12?
That's close enough.
11 or 12, 100 years.
Yeah.
And Bill is the founder and CEO of his own, he was the founder and CEO of his own food service sales and marketing company for 25 years. Bill and his team handled all food service sales and marketing functions for some of the nation's largest food manufacturers, representing companies such as Nestle, Sara Lee, and H.J. Heinz. His team quickly grew to over 75 people, including 4 executive chefs in multiple locations. He has served on several national advisory boards and was president of Market Tech, a national industry collaboration group. In 2006, he completed the sale of his own company and joined Tech Coast Angels, becoming an investor, membership chairman, and board member. Additionally, he joined SBDC as a senior consultant in 2008. Bill applies his strategic planning skills and business instincts to the everyday dilemmas faced by business owners. Over the past 12 years, he has helped businesses access in excess of $95 million in capital to launch and grow their businesses. He serves as a senior consultant for the SBA, SBDC, and offers his experience to early stage ventures through our center. Focuses on technology, consumer goods, and the food industry. And as Bill says, entrepreneurship is an attitude. It's not just a business term anymore. It's a way of life. Welcome, Bill Waldo.
Well, thank you for that. Appreciate that. Well, good afternoon, ladies and gentlemen. I'm impressed with the turnout, given the fact that it's not only raining outside, but it's also thundering and lightning. So those of you that did make it through, welcome. Happy to have you here. So I'm going to start off with a little exercise, okay? So bear with me. I'm going to ask each of you to take a deep breath, raise your hands all the way up in the air. Okay? Take a deep breath. Now let it out slowly. Beautiful. What you've just accomplished, you've set yourself up to absorb everything I'm going to tell you over the next hour. Just trust me, your brain is now fully alert. Absolutely. So let me go ahead and begin with a couple of questions. How many of you are planning on going into business? That's what I would expect. Okay, with that said, how many of you are planning on raising capital? And would that be equity capital or would that be debt financing? Either or. Okay, so the majority of you here are definitely interested in raising capital to grow your business. Well, good. Welcome. That's what we're going to talk about today, if I get this thing right. Very good. So I'm going to begin with talking about something that I think many of you have heard about in the past, but it is something that I have experienced over the years of being a part of Tech Coast Angels and having sat through probably 2,000 entrepreneur presentations. One of the key areas that are probably the most critical is for the entrepreneur to master the ability to articulate clearly exactly what it is you do. And I can't emphasize that enough. I can't tell you how many times I have facilitated screenings. The entrepreneur gets up, starts making his presentation. I can look around the room and tell you right away how many investors got what the person does and how many didn't. They're either looking at their watch or they're squirming in their chairs, but clearly they did not get what it was the entrepreneur does. Hence, the entrepreneur lost that investor because he didn't have a clue. So with the elevator pitch or the fast pitch, which is known as, some of you may have even been in the contest that we've had here in the past. In fact, Tech Coast Angels sponsors a contest every year, our fast pitch contest. You really have about 30 to 45 seconds. Sounds unbelievable, I know, but that's really the attention span of the average investor or even the customer, where they're going to capture what it is you do. So you've got to be able to get that message out on who you are, what you do, why you do it, how you do it, and you've got to do this in about 30 to 45 seconds. It is worth every minute you spend on it. I advise my clients to go to their friends, go to their family members, ask them to humor you for just a minute, give them your pitch. Tell them exactly what it is you do. And if they can come back to you with exactly what it is you do, congratulations, you're spot on. And that's what you want to be able to do. What happens oftentimes that I've seen is an entrepreneur will make his presentation, he'll do a pretty good job, but what happens is the investor or the customer, they thought they got it, but they really didn't, and they put you in the wrong compartment. Hence, you've still blown it because they kind of thought they knew what you did, but they really didn't. So it is absolutely critical that they're clear right out the gate what it is you do. Now, you set the stage. They at least understand what it is ABC company does. The next slide, which again starts setting the stage. Remember, what we're doing here is we're putting together a very compelling story. Our goal is to be able to articulate an entire story to the investors about what it is we do. We want to throw out hooks. We want to keep their attention. I'm a sales guy. I don't want to put anybody to sleep if I can help it. So please try and stay awake while I go through this. Okay? But we want to be able to keep their attention all the way through it. So one of the first slides we start off with is the problem. What is the problem you, the entrepreneur, has identified in the market space as a significant problem? And I recommend 3-4 bullet points. Define what the problem is you found out there. Every entrepreneur becomes an entrepreneur because he has identified a major problem in the market. Okay? As an investor, I need to understand what that problem is. How big of a problem is it? Is it really a problem? Okay? So, we want to be able to identify that problem as clearly as we possibly can. And then guess what? Next slide is, what is the solution for that problem? So, oftentimes I have to ask clients, do you have a solution that's looking for a problem? Or do you really have a solution that's going to solve the problem? So, I need to know, how are you going to solve the problem? So if you've got 4 or 5 bullet points listed on your problem, we'll do the Q&A if we can. Otherwise, I'll completely get off track. But we'll definitely have time for that. So on the solution, we want to be able to match the problem bullet points, okay? So if the problem was there's a major problem in the market with technology that doesn't address this or doesn't address that, we want to be able to show in the solution slide, line by line, exactly how we're going to address that problem. So now you see we're starting to build a story here, okay? We've got the elevator pitch out. People understand what it is you do. We've identified the problem or problems. We've come up with the solution. This is what we do. This is our business. Here is how we're going to solve this problem. Make that very clear. So now you've got 3 key things. So you've set the stage, the story is beginning on how you're going to solve the problem. Next slide, again, not necessarily in this order, although it's my preferred and favorite order, but don't worry about the sequence. Right now, what I want to talk about is more the content, okay? And one of the things I want to also add in here is I'm showing you today all the right things to do that I've learned in terms of putting together a deck, but part of what we're going to discuss in Q&A and part of what I'm going to add during this, because my colleague couldn't make it, is a lot of the things you shouldn't do. And I'll back up for a second and I'll reemphasize the opening comment about what it is you do, the elevator pitch. So many times, entrepreneurs don't get that right. That is one of the critical things. Market size, so let's go to that. Most of you probably have heard the term TAM, SAM, SOM. Now, what the heck does that mean? Sounds a little bit too wild to me. Well, Investors want to have an idea how scalable this business model is. So it doesn't have to be complicated, but what we need you to do is do some research. We need to understand what is the total available market, the total demand for a particular product or service. For example, I'm in the lighting industry, okay? The lighting industry is a $100 billion industry. Beautiful. However, I sell fluorescent tubes. So my serviceable market, or the area that I am into, is the fluorescent tube. So if that $100 billion market, my market that I'm going after is $15 billion. So it shows the entrepreneur, it shows the investors that you're doing your homework, okay? Here's the whole market that I'm after. I've done my homework, I've done my research. Then this is the serviceable available market. This is the segment of the TAM, the total addressable market, by products and services which is within your geographical reach. Then the last one is the serviceable and obtainable. This is really what matters. This is where you guys, ladies, are going to fit in. Of this whole market, here's where I feel my product line, my service is going to be the best fit. So if it's a $100 billion market, I'm going to lock right into the $10 billion size, and this is where I see my business product going. Very, very important that we're identifying how big this market is. I, as an investor, need to know that you're looking at a highly scalable business model. That's what I want to invest in. Okay? One of my favorite slides is this one. Some of you in here that have had the pleasure or less than pleasure of working with me, this particular slide, it's not done well. I need to clean it up a little bit, but it's a competitive matrix. It was kind of a joke at the time, but it doesn't really serve my whole purpose. In fact, we just talked about this yesterday. The competitive matrix is a very good visual, unlike this one, that vision a column on the first column there that will identify all the features and benefits of what your business model service does. Next column over, in this case, the company is called My Donut, really original. You get a check mark all the way down because guess what? You have all of those features and benefits. Beautiful. Okay? Next line over is your competition. You may list 2 or 3 of them. But guess what? They only get maybe 1, 2, or 3 check marks because that's all they have that matches what you have. And if they don't have it, leave it blank. When that's done, trust me, you have a very good visual that answers 2 key areas that investors want to see. One is, why you? Remember this. This question is going to come up all the time. Why you? Why now? Well, this is a real good example and a really good visual that allows you to articulate why you. You look up here and you can see all the key differentiators that you have versus your competition. It also tells investors that you know who your competition is. So again, this is a really good way to communicate not only to investors, but even to your customers. It makes a great marketing tool. When you put one of these together, it's a great way to open up a brochure and say, let me tell you why my product, why me versus other people. We have all these features and benefits. They have this and this, but we have all of these. So there should be no doubt in your mind why you'd want to come to us. Competitive matrix, extremely helpful. Answers a lot of questions. Now I'm going to talk about one of the most important slides in every presentation. You may have heard the saying, I repeat it probably 10 times a week, but entrepreneurs, you're in the audience, you're going to laugh at this because you've heard it a million times. Entrepreneurs investors have got to be madly in love with the model or the horse. I'm going to call it the horse today. I mean madly in love with the horse. The horse is your business model. Okay? But you know what they got to be absolutely enamored with? I mean completely in love with? Is the jockeys. It's you. Because at the end of the day, the investors are going to invest in you. They're going to assess, they want to understand what makes you uniquely qualified to be the entrepreneur, to be the CEO, the COO, the CTO, whatever your role is, to drive this business to the levels we're talking about, which we'll show in the financials over the next 5 years. It is absolutely critical that we identify the management team. What we're looking for is not the big pictures and the smiles and all the 15 different degrees. I mean, all that's nice. But what we're looking for is, what have you accomplished? Again, what makes you uniquely qualified to grow this business to the next level? That's what I want to be able to see. What are your strengths, accomplishments? If you work for IBM, you took over a unit that was doing $15 billion in sales. When you left, they were at $100 billion or $100 million, whatever the number is in sales. That's an accomplishment. If you had a business in the past and one of them failed, one of them sold and did well, beautiful. I need to know that. That means you've learned two things. You learn the pain of what happens when you lose, and you also understand what it takes to grow a business. Those are incredible accomplishments from an investor's perspective. Education, background, MBA, computer science, all the other areas of academia are critical. If you have them, they're certainly helpful to have on there. But I can tell you, it's the experience and what you've been able to accomplish is what really matters to investors. Experience, experience, and more experience. So, that's the management team. These are the core key people within your company. Very important. In fact, it's the preference of all investors that the CEO is the one up there doing the presentation. That is always a preference, and that's something that you should know, and most companies typically would do that. But there are always exceptions and good reasons for exceptions. The other slide that I recommend that you add is the advisory board. As an early stage company, none of us are going to have 10 or 15 people in the management team because we're an early stage company. We don't have the funding and the finances to have a big team. So we're going to list our good quality management team, and all of you have that. So the next slide would be the advisory board. This is an informal board. Okay, ladies and gentlemen, this is not your board of directors. I'm not recommending that we're even there yet. This is strictly an informal advisory board of people who have agreed to be on your board. Now, as far as compensation, you can offer them warrants. You can offer them some kind of a small equity position if you wanted to. You could offer them a finder's fee. I mean, it's purely up to you. Many times, nothing has to be offered. There are people that know you, they love you, they trust you, they like you. Okay? The advisory board is critical. If they have, and again, it's the same bio on the advisory board that we like to see with the management team. What's interesting to us as investors on the advisory board is the individual's Rolodex, their connections. Who do they know? If I can read a quick background on somebody's background, and it's clear to me that they've got a Rolodex, they've got a network and connections, and that the entrepreneur or the CEO can just make a phone call to that particular advisory board member, and he can help him grow his business, sign me up. That's what I want. I want an advisory board member that clearly has the experience and has the connections that can help the management team grow their business. Okay? They've got contacts. That's what we're after. They've got industry experience. So having there's a $25 fee for that. Okay, that's okay. I'll give you a break. Now you know what it is. So on the advisory board side, I caution you not to put your CPA on there. He's nice to have, but he's not going to help you grow the business, or your attorney. What's really important are people that have got industry knowledge and can help you grow your business. And it also adds more bodies. You've got the management team, and you've got your advisory board. Very helpful. So next step is, all right, so if we've gone through the story. We're building it now. We've talked about our business model. We've talked about who we are. We've talked about what we do, problems, solutions, okay? But now, as an investor, you're asking me, because everybody does, you want to raise $1 million, okay? That seems to be the magic number these days. Okay, cool. So next step is go-to-market strategy. What's going to be your sales and your marketing channel strategy plans? How are you going to push this out to the masses? I give you a check for $1 million. I need to know clearly what processes do you have in place? Are you going to hire independent reps that can provide you with access to the market nationwide or globally, which is a nice pay-for-performance model? If that works, it's certainly preferred. Okay. Are you going to hire brokers, which I did when I was in the food industry, people that, again, provide you with access, but again, it's a pay-for-performance market or sales model? Are you going to have a direct sales force? And I caution you on that, because as an early stage company and as an investor, I get very nervous when I see a bloated payroll of staff members in a direct sales position for an early stage company. So again, it's very important that you think through your go-to-market sales strategy. How are you going to push it out to the masses? I have VARs up there for those of you that are not familiar with value-added resellers. It's one of the strategies. Strategic alliance partners. There's multiple strategies on how you can list it as how you're going to go to market. So again, the question that comes to you and the answer you want to have is, once I get funding, this is what I'm going to do to push this out to the masses. I skipped the first part. The other part is, are you going to be a B2B, business to business? Or are you going to be a B2C model? You need to think that through, because they're really two uniquely different models. Some investors prefer a B2B model. It's more efficient, more effective. The growth potential is greater. Risk mitigation is somewhat there. So B2B, for some people, it's preferred. B2B ostensibly could be, it requires more capital, more time, more energy, etc. Doesn't make any difference. My point is, we want to identify if you're going to be a B2B or a B2C and define that. And you could be both. And you may start out with a B2B, and as you evolve, you become a B2C. But it's important to define who is your customer. Is it going to be a business, or are you going to be going one-on-one with consumers? So let me go back to my sales and marketing channel strategy. I covered the sales side of it. The other part is marketing. And do remember that there is a big difference between sales and marketing. I'm a sales guy, and I had to fight that my entire career, because I was always dealing with marketing people who thought they were doing everything. So on the marketing side, same thing as on the sales side. We need a good definition of your strategy relative to marketing. Is it going to be a direct marketing campaign? Is it going to be a social media campaign? Do you have people in place that understand how to take the Facebook, the Instagrams of the world, and turn it into a good, solid marketing campaign? Those that can do it have done very well. I've got several clients that have done extremely well on the social media platforms because they have talented people that understand how to reach out and make the Facebooks and the Instagrams of the world work for them. I've had them reach out to where they'd get key influencers, which has been extremely successful for many clients. The key influencer side of it can be very powerful and a very good and not overly expensive marketing tool. So you want to make sure you've identified a very clear marketing channel strategy. Alliance partners is another one. These are people that you're benefiting them and they benefit you. So by you working together, they can refer you to clients and your product helps them grow their business. So finding good alliance partners is another excellent marketing channel strategy. Okay? The business model. Okay, that is a good one because it answers the question that most investors would like to ask you, and that is, how do you make money? How do you make money? Makes sense, we probably want to identify that. So we want to talk about what revenue streams do we have? Is this going to be a subscription model? Okay, that's how you make money, great. Is it going to be a software as a service platform? Everybody likes to see that in technology. It grows fast, it shows phenomenal profits, but we need to know how you make money. Is it going to be from advertising? Okay, so think about it, and my advice to you is the more revenue streams you can come up with, the better. 2, 3, 4, whatever it is. We know that 1 and 2 is going to be probably 80% of your revenue, but think it through and identify the key revenue streams. Put them up there as your business model. This is how we're going to make money. Here are the revenue streams that's going to generate the cash flow. Proof of concept. Everybody has their own interpretation of a proof of concept. As investors, I can tell you what we look at as proof of concept. And that is when a customer is willing to write a check and he's buying the product. That is the best form of proof of concept that I know of. And it's critical when you're presenting to investors that you have something tangible that you can put your hands on and say, okay, I have tested with pilots. Here's what the pilots are saying. I've done beta testing. But it's being able to show that people like what you're doing, and hopefully they're buying some of it, and you have some revenue generated. This changes the tone dramatically when you're talking to investors. It's great for what I'm going to say. I'm a sales guy, and I can tell you that I got the greatest product there ever was, and I can tell you it's going to do $100 million in 5 years. Well, what I need to see, and what's important here for an investor, is tell me what the customer says. Do you have customers? Even if they're beta customers, I need to know what they're saying. That's what matters to me. I need to know what the customers are saying. Will they buy it? Hopefully you can prove that they will. If it's $2,000 a month, at least you have been able to cross over that big milestone, and you have gone from a person that is thinking about going into business to where you're now in business. You're in revenue. You have customers. And guess what? They're paying. That's what you want to have. And if you can bootstrap it to get to that point, good for you. I encourage it every day of the week because it makes a huge difference. It increases your chances of getting investor interest because you're able to prove that you've got not only proof of concept, but you have proof of customer. 2 very critical components to the whole investment world. So let's talk about intellectual property. Not everybody is going to go after that, but it's extremely helpful, especially depending on the product. or the business model that you have. But if you, the big question that comes up in every single presentation is, what are your barriers to entry? What's going to make it difficult for someone else to come in and eat your lunch, so to speak, and basically copycat what you're doing and take it over? As an investor, I need to know that there are reasonable barriers to entry or some areas that's going to make it very difficult for somebody to come in and duplicate exactly what you're doing. So, with that said, do you have proprietary assets? Do you have intellectual property? So, do you have a provisional patent pending? Is it pending? Where is it at? And if you're one of the few fortunate ones, if you have patents already issued, let's talk about it. Let's get it up on the slide. This is important. We've got to be able to communicate to the investors that we have barriers to entry that's going to make it very difficult for my competition to come in and catch up with us. Very important. So again, proprietary assets, barriers to entry, we want to define what they are. Financials. This one is always fun. We look for clear, concise, and current information. Investors prefer a 5-year financial model. What we're looking for is not 10 pages of details, cost analysis, all the different things that you can put together. For the investor pitch, what we would like to see is a 5-year projection. Okay? First line, for example, is going to be gross revenue. So 2019, I'm going to do $2 million. 2020, I'm going to do $5 million. So on up for 5 years. What you want to avoid when you do this is hockey sticks. Most of you probably know what a hockey stick is. Those of you that don't, that's when you go from $5 million one year to $25 million the next year. It's typically unrealistic, and it's going to cause the question of, okay, tell me what kind of a magic act is going to happen that's going to cause you to jump that much in 1 year. So we want to avoid the giant hockey sticks. We want to see a good 5-year solid growth plan. It's got to be realistic, but it's got to show that it's a good, scalable model. And I'll also tell you, investors, they don't believe anything you have on there. They don't. I mean, it's purely a projection. But what's important here is that you have taken the time to think it through, based on your assumptions, based on your formulas, all the research you've done. This is what I believe will serve as a very good projection on where we think we're going to be in the next 5 years. So we're looking for the gross revenue. We're looking for COGS, cost of goods, right on across there. Okay? We're looking for your G&A estimates. I recommend that you separate sales and marketing costs out of that. It's always helpful because investors want to know that a significant portion of that raise is going towards sales and marketing, which is really what it's all about. Okay, you want to put in your gross profits, margins, EBITDA, if you have it, put it in there. It's helpful. But it's really kind of like a miniature P&L format. Not complicated, simple, but it's right to the point. And it tells a very good story of how you see your business flowing and what kind of growth you're predicting. Okay? Next slide. This is another one that gets everybody's attention. Saving it, I'm trying to come out with bits and pieces. I want to have hooks out there. So the next slide is the deal. Okay, this is what it's all about. This is why you're here. So what is the deal? How much money have you invested? I advise clients to right away, this is not a time to be shy, put on this slide right away, how much money have you, the entrepreneur, personally invested. This is not, what am I trying to say here? This is not all of the pain and suffering that you've gone through. This is cash. It's assumed that you've gone through all of the hard issues, but this is cash. If you've got $100,000 of your own money in this, first thing up there is investor or founder invested $100,000. Okay? Beautiful. Next one would be secured $200,000 from family and friends, which, by the way, most of you already know that's probably out of 95% of startups, that's where that first $100,000 comes from, is family and friends. They know you, they love you, they trust you. Guess what? Investors, they don't know you, they don't love you, they don't trust you. That's the reality. So it's identifying how much you put in it for skin in the game, how much you've raised from family and friends, and if you've raised money from other investors, great, put it on there. So now we start right off with, okay, 100,000 from family and friends, 200,000 from other investors. Total raised so far, $300,000. Well, that's impressive. From an investor's perspective, I look up there and I think, well, wow, they've already raised $300,000. They've got early adopters, early believers. Good news, okay? Then we put down how much we're asking. $1 million, $500,000, whatever that number is, we need to put down the ask. After that, what is the offer? The offer can be equity. Okay, that's very popular. Or it can be a convertible note. Typical convertible note. I used to not like them, but I can tell you, Tech Coast Angels, for example, last year, 60% of our deals were convertible notes. For those of you that are not familiar with the convertible note, it's very simple. It's typically with an interest rate. It's a note. It's a formal note. Interest rates 6 to 8%. Usually has a 20% discount. Allowing the early stage investor coming in gets a discount when it converts to stock. So convertible notes are very popular. So we want to be able to identify what the instrument is we're offering and what the valuation is of the company. If you're raising $1 million and you're offering 20%, the investors can do the math and the valuation is going to come out. But keep in mind, the valuation is going to be there. It's always one of the sensitive subjects because investors are never going to agree with you on the valuation. But we have to have one there. What I tell my clients when they're doing their presentation and the valuation becomes an issue, I just tell them, hey, you know what? When we get into due diligence, we can have a discussion about valuation, and that usually ends that topic. But for the offer slide, this is what we want. How much money has been invested, how much money have you already raised, and what the deal is. So then we go to the next slide. Use of funds. I don't know if I have that. Okay, I'll get to this next. Use of funds. So you want to take the next slide and not cloud it or get it involved with the deal slide. But the next slide is going to be, if it's $1 million, list the categories on how you're going to spend that $1 million. Don't make us do the math and figure it all out. Don't use the percentages. Spell it out. If $250,000 is going to go to sales and marketing, put it on there. If $100,000 is going to go to development, great. If another $250,000 is going to go to G&A, just list them. They don't have to be absolutely perfect, but I want to get an idea as an investor where your thinking is. How are you planning on spending my $1 million over the next course of several months? Very important that I know that. What I'm looking for, or what I don't want to see, I should say, is I'm going to pay off Uncle Bob's debt. I'm going to buy somebody out. I'm going to pay myself $175,000 a year because I think I'm really good. So what I'm looking for is a realistic, bottom line, I want to see the money going to growth. That's what matters. Then I'm going to ask you as an investor, what are your future capital needs? So keep in mind and be ready for that. Every entrepreneur at some point is probably going to need to raise more money. And a typical question that's going to come up is, okay, let's say you're raising $1 million. So the question comes up, how far is $1 million going to take you? We need to have a response. Is it going to take you to cash flow positive? Is it going to take you to profitability? Or is it going to take you to a runway of 8 months and you're going to come back for another $1 million? I need to know this. And it's just wise to bring it out right up front so we get a pretty good idea where your thinking is and how far it's going to go. And then, we're coming to the end here, we get to the exit strategy. What's important about the exit strategy, there's actually 3 key things. One is that you have one, because without one, guess what? You're considered a lifestyle company, which is fine. My business was a lifestyle business, and it was fine. I wasn't trying to raise money and grow across the country. But investors don't invest in lifestyle companies. Investors invest in companies that are being built to grow and sell. The only way I'm ever going to make any money is if you sell the company and you have a positive liquidity event. So the exit strategy is critical. Number 1, you have one. 2, it's most likely going to be an acquisition. Okay? IPOs, fine, but it's usually a dream. They're expensive. There's not that many that do it, and it's not typical. Majority of companies in 5, 6 years, whatever the number is, they're going to be acquired. So I'm suggesting that you say acquisition. That's my strategy. Then I would suggest that you put down 2 or 3 or 4 logos of companies that you believe are likely suitors, and just put them up on the screen, and there you have it. Very simple. My exit strategy, we're going to be acquired. Okay? Here are some companies that are likely suitors that we think are going to buy us. Boom, you're done. That's it. You have an exit strategy. So now you've, as you can see, you've told a pretty good story. You've gone all the way through it, and you've told me pretty much everything I need to know to make a decision. So at the end, and this is the final slide, instead of having, this is one of my favorite slides, so bear with me as I try to go on about it. Most of the time you'll see a slide at the end that says, thank you very much, call Bill Waldo at such and such number. Well, the thinking here is, why not be a salesperson? You're going to go through 12 minutes of Q&A anyway. Why not put a slide up on the screen that recaps all the reasons why I can't go another minute without writing you a check? What it does is it recaps the highlights that you've already talked about during your presentation, brings them back up in a summary phase, and it reminds me, maybe I fell asleep for a few seconds during the pitch, but all of a sudden I wake up and I see, wow, exceptionally high margins, experienced management team, scalability, they've got excellent intellectual property, whatever the reasons are. It's usually profit margins, it's a highly talented staff, it's all the things that will motivate an investor to want to invest in your company. So why not bring them together and let that set up on the screen? I call it free real estate. It sets up there for the next 12 minutes or whatever the time is of Q&A as a reminder, again, why you can't go another minute without writing a check. Okay? So that concludes my snappy how to prepare an investor presentation. I can tell you one of the things I've learned in the past, entrepreneurship is an attitude. It's not just a business term anymore. It's really a way of life. So with all that said, and thank you for listening to me, we'll turn it over to Q&A. And one of the things I want to do here is have an interactive Q&A. Fire a question at me, okay? If anybody else in the room wants to attempt to answer that question along with myself, go for it. I'd love to hear what your answer is to the question as well. So we already have a hand in the air. Let's go ahead and start with you.
Okay, so I have a startup in a sector that people don't know a lot about. I'm working in space tech, and I noticed you didn't have a lot of detail on the technology itself. And I know that people often wonder whether the technology is accessible. It's true for med tech as well. Do you just not give many details on what you actually do?
When you say details, what I'm interested in is what do you do? What does your technology do? What's uniquely different about you? Why would I want your technology versus everything else out in the market? I want to know enough about that. I don't want to get into a lot of technical details because we don't have enough time, and you'll probably go right over my head. But I need to know exactly what it is you have that's unique and different. Is that answering your question? Or
Well,
did
I
miss
guess
it?
the thing is, I'm thinking that in order to differentiate myself from the competition, I need to explain what the technology itself is. And sometimes I spend half of my pitch doing that. We don't get through the rest of the slides because people keep asking questions. They're so unfamiliar with it.
I recommend against that. I recommend staying with what your technology is, the highlights, and why it's unique and different. Getting into a lot of detail is damaging because you're going to lose them, and you're not going to get into a lot of the key areas because you've got typically a timed presentation. You've got, for our group, you got 12 minutes, and you get 12 minutes of Q&A. So a lot of opportunity comes up in Q&A to ask you those questions.
Okay.
But my concern is, and why I didn't cover that, is we've had this happen. If it becomes a technology presentation, you lose the investor's interest because they want to know what you have, and they're going to ask you more questions later once you get into due diligence. But the whole goal, and I should preface this right away with your question, the goal of this presentation, once you put together this deck, is not to get a check during that first pitch. You want to get the investor's interest to where you have the next meeting. Then you get into more detail. And that's when you get a chance to get into more of your detail. Am I answering your question now?
Yeah, that makes sense.
Okay.
Yeah, thank you.
All right.
I want to thank you for the clarity. I've seen a lot of pitches, and you've really kind of given us a sharp focus of what's going on. You have, over here,
Oh, thank you. Jeez,
You have
unreal.
7.
Where's this coming from?
You gave us 17 slides, and you say at Tech Coast Angels we get 12 minutes. So
Yes.
where I come from, you're lucky to get a slide up through in 45 seconds. I can do it, but a lot of people can't. So if I'm tight for time, or maybe I only get 10 minutes, do I cut specific sections generally, or do I cut the ones that perhaps are less interesting or less relevant to my particular company and put them in backup?
Good question. You just answered it. You cut the ones that are least relevant. It's the slides that I tried to talk about there that investors are looking for. They want to know the problem, the solution, and most important, obviously, what it is you do, then the market size. All of these things are designed to pique their interest, get their attention, and then want to meet with you at a subsequent time to start doing a deeper dive. And it's a challenge because a lot of these are timed. I actually tell investors or entrepreneurs to do 2 decks. One that you send out that could be 30 pages long and you hope they read it all, okay? And the other deck is the timed one, which is what I presented today, that is designed to be delivered in 12 minutes, which is about the attention span you're going to get. Okay? All right.
Hey, Bill. Thank you.
I think, go ahead. Go ahead, Anthony.
Hi, thanks for doing this today, Bill.
Sure.
So the question I had for you had to do around defining your SAM and your SOM. Because the TAM I find easy to calculate. It's just a matter of researching what the size of the market is based off what's already happening. But how do you break that down into what would be the SAM or SOM? When you see $1 billion market, optimism would say, listen, we're going to get 50% of that. Reality would not be the case. So how do you decide to break that down?
It's a challenge. Depending on the business model, it becomes even more difficult for some. Okay? And I happen to know your business model, and it's going to be a challenge for you to do that. What we're really trying to get an idea of is how big is the whole market. And then I want to know, are you going to go after 1% of that? Are you after 2% of that? What piece of that big market do you think you're going to get? That's really what I'm trying to figure out. And it helps me understand how well you're really thinking this thing through. You know, it's people that are going to be the next Google or the next Apple, and they're going to do $100 billion in 5 years. That makes me nervous as hell. So it's trying to just really narrow it down to where do you think you're going to fit into this? Okay? All right. I'm sorry, I didn't get your question. Run it by me. Okay. You're going to hear that. I can't deny that. What we hear more of is the opposite. What we hear is it's a conservative estimate. And that drives investors nuts because we hear it all the time. I mean, that's the standard thing. If an investor thinks it's a bigger market, that's great. What you're looking at and what you're presenting is what, from your research, this is what I consider to be the realistic market. You can debate all day long whether or not it's going to be bigger or smaller, but you've done your homework. You're showing what the total addressable market is and what the serviceable market is. I don't know if I'm answering your question, but I'm trying. Okay. Yeah, you're going to get. Yes, I've heard that happen. Yeah, you're damned if you do and you're damned if you don't. And if you got a ridiculous 5-year financial, somebody might say, you know what, you're not big enough. Well, I was trying to be realistic in my numbers. There was somebody over here that had a question.
Yeah, so the question I have is, pitch deck aside, all the slides aside, what kind of suggestions do you have for people? Because I think the biggest thing that I keep hearing is the common denominator is investors invest in people. And one of the things that we're faced with is a lot of organizational culture issues. So how can people present to you or to an investor and show up in a way that would position this company for strength because their idea is good, but the people are solid?
Good question. I'm glad you brought that up. Okay, so one of the things that I should have probably mentioned is it's one thing to deliver a great presentation, okay, have all the right content that I tried to talk about today, but the other part is the person. Investors are, once they get the model and they've got it, they immediately shift and they start evaluating you. They want to know, are you coachable? Are you coming off as being coachable? Are you coming off as being honest? Are you sincere? Are you really somebody we can work with? All of these thoughts are going on once they get the business model. Because at the end of the day, like I said earlier, it's you. You're the one they're going to invest in. And it's, if perception is reality, let me tell you, in an investor room, it is reality. It's how you deliver that business model. The content can be great, but if you blow it on the delivery, you're in trouble. So you want to project a good image of yourself. You want to convince the investors in the room that you've got the experience, you're uniquely qualified, you're a nice guy, I'm smart, I've got passion, I've got energy, I know what I'm doing, I'm going to build this business. And that's what they're looking for. Hopefully I'm locking in somewhere, at least somewhat close to what you're trying to ask, but it's the person. It's how you position yourself and present yourself has a lot to do with the investor's decision.
Thank you for your time today. I appreciate that question.
Certainly. Happy to be here.
Bill?
Yes, sir.
Just going back to your very first slide, and you obviously wanted to get the pitch off on the right foot. Just what's your definition of identifying a problem versus identifying an opportunity that you see? For example, Airbnb, there probably wasn't a shortage of hotel rooms before they thought of pitching Airbnb, but there was definitely an opportunity there for Airbnb. So how do you make sure that you're really identifying the problem versus just saying, I see an opportunity?
You do a lot of research, and if you think you're identifying a problem, I advise people to go out and survey and talk to target customers and find out, are they really having that problem? Am I really addressing a problem, or am I trying to come up with a solution looking for a problem? It's like Uber. Okay, nobody knew there was a problem, but all of a sudden they came up with an idea where you can bring the cab to you instead of you having to go to the cab. So it's research. Thank you for that. It's the research. It's talking to customers and getting as much knowledge as you can that they believe in you and that they have the same problem that you're trying to identify. And then do you have the right solution? And I can't emphasize that enough. It's a very good question you asked, but You really have got to do the homework and find out, do others really share this problem? Because I want to know as an investor, how big is this problem? Do they really recognize this as a major problem? So good question.
Yeah, thank you.
I have a question on the proof of concept.
Yes.
You had mentioned that investors like to see a product that is selling, but I may not have the customers, but I might have customer confidence that this is something they're willing to buy. So would you recommend, how would you recommend to present that? Would it be quotes from the, potential consumers? Would it be a video clip? How would be a good way of showing that in such a short time and bringing that across to the investors?
I think if your question is proof of concept, how do you prove it? If you don't have customers, if you don't have anybody buying it, is that your question?
People say they love it,
Okay.
but we haven't had as much sales as we hoped. So we know the product needs tweaking.
Mm-hmm.
But 50% of the people are saying that this is something that they are willing to buy. So so how do I bring that across? I mean, do I need to rephrase some of their comments, or should I be capturing videos of their experience and they're saying, oh, this is wonderful, this is just what I needed?
My answer to that, based on my experience, and all I can give you is my subjective answer. I can't necessarily represent every investor in the world. I need more than that. Okay? It's like the lady that bakes cookies. All my family loves my cookies. They said they're fabulous, and they would buy them. Well, that's nice. I'm happy to hear that. But I need to know that customers are ready to buy. I have to have something tangible. It's nice to have people say nice things. But as an entrepreneur, when I'm out doing the survey that I was talking to this gentleman about, I don't want everybody just to pat me on the back and say what a great idea I have or this tastes delicious. I want to know, what is it you don't like? What is it I need to do different? How can I improve it? So we need more information to be able to communicate it. Trying to raise money without any business at all and just having people say nice things is very difficult. It can be done, but you're at that family and friend stage. It's at that point, and this is just from my experience, okay? You're at that point where those are the people that are going to invest in you because they know you, they love you, they trust you. And with that money, the goal is to gain enough traction and turn the people that said this is lovely, beautiful, I love it, it tasted, it's great, to where they're willing to buy it. It doesn't have to be $1 million, but they're buying it. So now you're able to tell us that people are buying it, and here's what they're saying.
Thank you.
You're welcome. Hopefully that helped you a little bit. It's probably not what you wanted to hear, but it's based on my experience. Okay. Other questions?
Clients you see vendors you see and or
Okay, so what your question is, are their chances better if they've raised a significant amount? Correct. Mm-hmm. I wouldn't say they're more likely to. If it's all family, if it's a mixture of family and friends and other investors, it is going to increase the chances. Family part is nice, but the biggest benefit of the family money is allowing you to gain the traction to get other investor interest. So I don't know if I'm trying to answer your question. Yeah, all family money is nice, but it is nowhere near as compelling as when you get early adopters, investors that are willing to take the risk and jump on board. Again, the family, they know you, they love you, they trust you, they're investing in you, but the investors, that's another story. And it helps to have that.
Would an equity, for example, trade equity for technology build, even though it's not cash, it's equity, does that sort of still, is that still viewed as, you know, someone investing in the idea? If we're trading out a bit of equity in the company for, let's say, back-end developments, although it's not cash, it's development work, how is that viewed?
If you're offering equity,
yes,
to raise capital, I'm not following.
So if we're willing to trade equity for technology development, for example, on a mobile app, which could be just to get an MVP is $200,000, and we have a mobile dev shop willing to trade out equity in the business for that work, how is that viewed? Is that viewed similar to raising cash?
It is. You're diluting your company as you offer that out. There's no question about that.
Understood, yeah.
But if you're gaining technology that's going to help the business model grow, it's done all the time.
Right.
Yeah. It's certainly not going to hurt.
I wanted to make a comment, if I can, on over here on this side.
Thank you.
Just to address over here, an investor really isn't going to care whether it's a family member, whether it's a friend, whoever. If you've bootstrapped and raised 100,000, 300,000, 500,000, whatever it might be, that shows the investor that you have people already willing to stand behind you. Doesn't matter whether they're really a family or a friend or not, at least from my perspective. You know, investors aren't going to differentiate that.
Well, there's family money coming from family offices, and then there's family and friends. So there's two different things. Okay. Okay.
And they're cropping out, right?
So what you're saying is that somebody's starting up and that actually they just have a good family bucket behind them, so that's
Yeah.
well, an investor, it doesn't matter. It doesn't matter as far as my perspective of how much bucket you have started. What matters more is what kind of traction you have. Traction and how much money has already been put into your company as far as investment are two different things. And you can have, you know, a bunch of money invested into your company, but if you have no traction behind that, then, you know, the investors still need to see that traction.
Totally. Yeah, perfect. Well said. Thank you. But I still feel like you're not getting the answer you're looking for. I want you to get more than a feel. Yeah. And a lot of it's subjective. It is. What he said is a very good point. I mean, the more money you raise, it's wonderful. But it's the traction you're gaining and what's happened with that money. Telling me that you raised $500,000 from family and friends is nice, but where are you at with that? Did it allow you to gain traction? Because the purpose of the family and friends is to gain the traction so you get in front of us, or investors, to go after a Series A round of capital. We can have a sidebar on that further if you want to. Okay. Okay. Good.
I have
Pardon?
a general question. Based on your experience, is it easier to get funding for a software company, a software product, or a hardware product, like a device, or something that's
Good
more
question.
tangible?
I'll give you the answer. It's going to be software. Technology type investors, and Tech Coast Angels certainly has plenty of them. Technology is going to be the attraction, more so than hardware. There's no question about that. And sometimes it's a tech hardware combination where one's required with the other. But if your question is which one is going to get more attention, is it technology or hardware? My answer would be technology.
Well, hardware could be technology too,
That's
but I'm
correct.
differentiating the software and hardware. The reason is because I'm advisor to a company who's developing a semiconductor chip, and we
Okay.
have a hard time convincing VCs of the value add. So they say, if there is really a market for this chip, how come Qualcomm hasn't done it? How come Intel hasn't done it? They don't get the technology behind it.
That's the
So
problem you're
that
running
is
into.
the challenge.
That's the challenge is the audience you're talking to. Okay, if you're talking to a life science audience and you're talking about a technology and chips, you don't have the right audience. And it's going to be critical that people get technology to fully appreciate the value proposition. I have had the exact same problem you're talking about. You're talking about a design of this supernatural chip, and everybody's saying, well, if it's that great, why haven't the industry giants done this already?
Exactly.
If they saw a need for it, they would have had it. Well, it's the same story. There's no reason why you couldn't come up with something that they didn't come up with and go out and be able to prove that it can take off.
Right.
I've seen it happen.
And then on the other side of the coin, we have taken the same pitch deck to China. And it's much easier to convince Chinese investors to buy into the technology than it has been in the US. It's just remarkable the difference between Chinese investors understanding the hardware technology versus US, which is more and more geared toward software technology.
Have you had experience in getting funding from Chinese on the technology?
Hopefully within the next month, we would be closing our first round with a Chinese investor, yes.
Okay.
Whereas
Well,
we didn't have any luck in the US.
It's a hard one to answer.
So
I mean,
it's-
I have my initial answers, but they're not
It's
fair.
very disappointing, that's all I can say,
Yeah.
you know.
Well, I guess the best answer is who is in your audience as a potential investor. If they understand technology, if they understand semiconductors, they get exactly what it is you do and it's going to do, that should stimulate interest. Whether they're Chinese or if they're Americans, shouldn't make any difference. Now, there's always a concern about what the Chinese are going to do with that technology, but that's a whole nother story as well. Yeah. Okay. Yes, sir.
Got some funds.
When is the valuation? Well, there's a pre-money valuation, which is what we typically look for. So when you're presenting, you're going to have some kind of evaluation. Nobody's going to ever probably agree with you, but an evaluation has to be there. Question is, how do you set evaluation? And that is all over the table. I couldn't even begin to address that one for you.
To ask you that, but I
I
realized
knew you were going to. I could see it on your face. It's how much money's been put into it. Do you have customers right now? The potential for the future growth, any intellectual property that's attached to it. All of those factors are built in when they start coming up with the valuation. But at the end of the day, when you're trying to raise capital and the investor is putting together a term sheet and he walks in and says, you have a $3 million valuation. I'm willing to invest, but I'm going to put your valuation at $2.5 million. He has the leverage at that point, and you have a decision to make. That's really what it boils down to at the end of the day, because if they really like it, the valuation can be negotiated. But if your question is, do you have to have a valuation when you pitch? Yes. If it's not, readdress it.
do investors generally help with better evaluation of the company? So is it also in your best interest to help us properly evaluate the company?
We're going to do that.
Right.
It may not be something that you enjoy, but yes, when it gets into due diligence, there's definitely going to be that discussion. So for now, to keep it simple, I would put what you consider to be a reasonable valuation based on a lot of the factors I mentioned. Talk to some different people, okay? I wouldn't spend 100 hours and a ton of money on it, but it needs to be realistic because remember, it's a pre-money valuation. It's not a valuation of where you think it's going to be at in 10 years. A lot of people make that mistake, and deals are blown because they walk in as a startup with a $25 million valuation, it's a deal breaker before they ever get the first word out. So it just needs to be realistic for an early stage company based on where you're at and what you have.
Thank you.
Certainly, absolutely.
Hi, my question is around the incubator program. I heard there is an incubator program associated with the UC Irvine. What's the process for non-UCI, family related?
That is outside of my wheelhouse.
Okay.
There are people here that can answer that for you, and I'd much rather have them answer that than myself. They have a complete set of criteria to become a part of their Wayfinder program, and I'm sure there are some people here that'd be happy to answer that question for you. This is a Wayfinder telling you where to go.
She
so there
said,
you go. That's
talk
pretty good.
to you. I spoke to, she said she wouldn't know about.
Okay, then
Yeah.
To be a part of the
I'm surprised.
Yeah.
or the Cove.
Or the incubator program for those that are not part of the UC Irvine. The incubator program.
I think she's talking about Wayfinders.
Right.
The incubator over at 5171? Uh-huh. You wanted more information about it? Oh, so there are two, right, so there are two incubators in this
Well, they're debating that. What's
office
your
park.
question?
Yeah, there's two. Them to respond. What is the normal
Good
protocol?
question. I'm glad you asked that. You as an entrepreneur want to be just as aggressive as possible. If you've got 5, 10 investors that indicated interest, you want to find out who they are and stay in touch with them right away. Because every day that goes by, they can quickly drift away. I've seen it happen millions of times. In fact, we're improving our own process at Tech Ghost Angels to where if we can't find a deal lead right at the very beginning, which is absolutely necessary to take it to the next level, it dies. So you want to be right on top of it anytime, whether you're talking to angel groups, if you're talking to a high net worth individual, anybody that you're talking to that has expressed an interest, my suggestion is when the conversation comes to an end, get the next date set when we can come back together and talk. And stay right on top of it because it's like anything else. It can quickly go away and you want to hit on it while it's hot. Okay? Good.
Hi, I have a business-to-business company.
You do. You have a B2B company.
B2B.
All right. Good for you.
And I have no problem getting in the door, and I have some great alliance partners. My challenge is going to be like you said, the hockey stick, because I'm getting invited to bid on things that I would have to ramp up very quickly within funding and support, basically contractors or initial investments on that contract. So is there a way to get established with potential investors and then when the time comes, pull the trigger and say, okay, this is a contract and something that we feel has value and move forward?
You're almost looking for a line of credit. It's almost what it's, in other words, you're looking for money that's available if you need it to expand.
Yes.
That's a tough one. I mean, there's purchase order ideas. There's different ways of raising money based on if you get a purchase order from a company. There's invoice purchase order factoring that a lot of companies have done. It's expensive. It's not the best way to do it, but it's one way to get funding. It would be from my experience, to try to raise capital based on the IFCOM would be a very difficult one to do, unless you had a purchase order in hand. LOIs, letters of intent, are nice, but they're not solid enough.
Okay.
It's not what you wanted to hear.
No, I have the one company that I have some good support for has a relationship with a bank that would back.
The bank would back you?
So the bank and the company have a relationship to support.
Okay, now you're talking. So you're talking about debt financing, and if a customer is willing to write a purchase order, debt financing can occur on that. A lot of banks have types of loans that will do that.
So is that something that I could explore with other investors outside of, say, going through the traditional bank, or should I just stick with that
I
company
would stay
bank?
with the banks for right now. Based on your scenario, yes, I think your best chance is there.
Okay.
As long as you can support the debt.
Yeah, and that's where I'm very cautious.
Well,
I
and you
don't
should be.
wanna-
You should
I don't
be.
want to pull that trigger until I know. you
And
know,
I
it's-
respect that, and I think you're a smart lady in doing that, but I think that based on your scenario, that would be the better choice initially, gaining the traction from that, and then backing out of that and going a different route after that.
Okay, excellent.
That'd
Thank
be
you.
my thing.
Thank you.
I think we have one more, time for one more question.
Okay.
And then wrap it up.
Got it. Who gets the lucky You. Skip, go for it.
Thank you very much. Thanks for showing us the 12-step process, if you will, for a minute.
You're certainly welcome.
love it.
Hopefully it was helpful.
I think you've mentioned often that there's you pause and then you have another 12 minutes of Q&A.
Correct.
Is it your advice at that time to purely answer those without any more slides, or is it good to have an appendix that backs up expected questions and be able to flip to a slide that may not have used or refer to one you've already used to help answer a question?
Very good question. In the Q&A, and I probably should have spent a little bit more time on that, in the Q&A, you want to get as many questions as possible from the audience. So that means you want to be quick and succinct with your answer. You don't want to ramble on. If you got 12 minutes of Q&A and you want 12 questions, you can do the math. You got about a minute to answer it. If you have a supporting slide that's necessary and you can quickly capture it and show it, wonderful, as long as you're not scrambling through and wasting time. But the better part of it is to just answer the question. I joke about it all the time. When somebody asks me what time it is, I don't want to tell them how I built my watch or how my watch was made. I just want to tell them what time it is. And that's really what you want to do during the Q&A. Because that's half of your selling opportunity is during the Q&A.
Classic 5 things.
Yes. And some of those we've talked about in the past, and they are classic because they always come up. Valuation is always one of them. Okay? All right.
Great.
I think we are at the end.
Yep.
Julie?
That's it. Thank you so much for coming. Thank you, Bill.
Thank you. Thank you all for coming. You're a good audience. I enjoyed it. Thank you. I should also state that if anybody has interest in wanting to have more time as an SBDC client, please see Hannah, who's right here. She's got cards that she can hand out. There she is. She can sign you up or give you the information you need if you want to seek our consulting and help. Well, thank you. Appreciate that.
Oh, until we make this right. Oh, I won't say goodnight. I just want to make you laugh. I just want to see that smile.